Stop everything. I don't care what you're doing. I don't care if you're in a meeting. I don't care if you're driving. Pull over. Because what I'm about to show you is the moment when the silver market went from volatile to completely unhinged. And if you don't understand what just happened in the last 24 hours, you're going to make a decision in the next week that will either save you or destroy you financially. It's Thursday, February 5th, 2026. And ladies and gentlemen, the American guy here. Silver just crashed 12.83% in a single day. 12.83%. That's not a correction. That's not profit taking. That's not even a crash. That's a capitulation. That's panic. That's forced liquidations on a scale that we haven't seen since March 2020. Right now, as I'm recording this, silver is trading at $76.78, down $11.30 on the day. But here's what's really going to make your blood run cold. The intraday range today was $73.58 to $92.32. Let me say that again, $73.58 to $92.32. That's in $18.74 swing. That's a 25.5% intraday range from low to high. 25% in one day. On a precious metal that's supposed to be a safe haven. And gold? Gold is down $89.40, negative 1.80%. So let me ask you a question. When silver can drop 12.83% in one day, when the intraday range is 25%, when gold can't hold $5,000 despite central banks buying 328 tons in 2025, what does that tell you about the state of this market? It tells you that we're not in a bull market that's correcting. We're in a broken market that's collapsing. And the worst part? According to the latest news from Kitco, analysts are saying there's more downside ahead. More downside. We just crashed 12.83% in one day. We just saw a 25% intraday swing. And they're telling you it's not over. So shut up. Clear your mind. And let me walk you through exactly what happened, why it happened, what's coming next, and most importantly, what you need to do right now before this gets even worse. Because I'm going to tell you something that nobody else in the financial media is going to tell you. This crash, this wasn't an accident. This wasn't bad luck. This was inevitable. And if you were paying attention to the signs over the last 3 weeks, you saw this coming from a mile away. Let's get into it. Let me start with the raw data because I want you to see exactly how bad this is. No spin, no sugarcoating, just the numbers. For silver, the current price is $76.78. The daily loss is $11.30. That's a percentage drop of negative 12.83%. The day's range was $73.58 to $92.32. The intraday swing was $18.74. That's 25.5% from low to high. So silver opened somewhere near $88 to $90 based on the math. Hit a high of $92.32. Then proceeded to absolutely crater down to $73.58 before bouncing slightly to close at $76.78. That's not normal. That's not healthy volatility. That's a liquidation cascade. That's margin calls forcing traders to sell at any price. That's algorithmic stop-loss hunting on steroids. For gold, the current price is $474.40. The daily loss is $89.40. The percentage drop is negative 1.80%. The day's range was $4,791.10 to $5,092.70. The intraday swing was $301.60. Gold hit above $5,000, $592.70 to be exact. The bulls were celebrating. $5,000 is here, new all-time highs incoming, this is it. And then it got absolutely rejected. Sold off over $300 intraday. Couldn't hold $5,000, couldn't even hold $4,900. Now sitting at $4,174. And here's the key insight that everyone's missing. Gold is only down 1.80%. That's a relatively normal daily move for gold. Painful, sure, but not catastrophic. But silver? Silver is down 12.83%. That's 7 times worse than gold. Silver is getting absolutely destroyed while gold is having a bad day. What does that tell you? It tells you that the selling in silver is not fundamental. It's not because safe haven demand disappeared. It's because of leverage. It's because silver attracts speculators. It's because retail traders who don't know what they're doing piled into silver with borrowed money. And now the margin calls are coming and they're getting liquidated. This is the difference between investing and gambling. Gold investors are down 2%. Silver gamblers are down 13%. And if they were using leverage, they're down 50%, 70%, maybe completely wiped out. Let's talk about what happened at $5,000 in gold, because this is critical to understanding where we go from here. The news says $5,000 resistance holds. That's Kitco's language. $5,000 resistance holds. Let me translate that for you. Gold tried to break above $5,000. It got to $5,092.70. And then it got violently rejected. Sellers stepped in, profit takers stepped in, short sellers stepped in, and they said, not today. $5,000 was supposed to be the launch pad. That was the narrative for weeks. When gold breaks $5,000, we're going to $5,500, $6,000, $7,000. The sky's the limit, and it failed. Now, in technical analysis, when a major resistance level fails, what happens next? The market typically retraces. It pulls back. It tests lower support levels to find new buyers. Where's the next major support for gold? Probably $4,700, maybe $4,600. If we break below that, we could see $4,500 or even back to $4,200. And if gold retraces to $4,500, $4,700, what do you think happens to silver? If gold is down another 5 to 7% from here, silver could easily drop another 15-20%. That would put silver at $65, maybe $60. Do you see how this works? The failure at $5,000 in gold isn't just a gold problem, it's a precious metals complex problem. And silver, being the more volatile, more speculative, more leveraged asset, is going to amplify whatever happens to gold. Now let's address the elephant in the room. The news reports that central banks bought 19 tons of gold in December. The 2025 average was 27 tons per month, totaling 328 tons for the year. That's significant. That's real demand. That's sovereign nations, central banks. Governments saying, we want gold, we don't trust fiat currency, we're diversifying our reserves. And yet, despite that demand, gold couldn't hold $5,000. Despite 328 tons of central bank buying in 2025, we're seeing massive volatility and downside risk. What does that tell you? It tells you that in the short term, the paper market overwhelms the physical market. Central banks buying 27 tons per month is bullish long term, but it doesn't stop the speculators from getting liquidated. It doesn't stop the margin calls. It doesn't stop the algorithms from selling. The physical market and the paper market are completely disconnected. Central banks are accumulating physical gold slowly, steadily over years, but traders are getting wiped out in hours. And here's the cynical insider take that nobody wants to say out loud. The central banks love this volatility. They love it when gold crashes 5%, 10%, 15%. Why? Because it lets them accumulate cheaper. So when you see central banks bought 328 tons in 2025 and you think, oh, that's bullish, I should buy, you're thinking like retail. The central banks are thinking, great, let the paper market crash so we can accumulate more at lower prices. Let's go deeper into that $73.58 to $92.32 range in silver because this is where the real story is. $92.32 high, $73.58 low. That's a $18.74 swing. From the high to the low, that's a 20.3% drop within the same trading day. Do you understand how insane that is? In a single day, silver dropped over 20% from its high to its low. That's crash territory. That's Black Monday 1987 territory. That's March 2020 COVID panic territory. But here's what actually happened, step by step, and this is pure speculation, but it's informed by 15 years of watching these markets. Step 1 is the rally in the morning. Silver opens around $1.88 to $1.90. There's early buying, maybe some short covering, maybe some dip buyers from yesterday's action. The price rallies to $92.32. Traders are thinking, okay, we bottomed, the bounce is real, time to buy. Step 2 is the rejection in mid-morning. $92.32 gets rejected, sellers step in, profit takers step in. Maybe some institutions who bought at $1.80 are taking their 15% gain and exiting. The price starts to fall. $1.90, $1.88, $1.86. Step 3 is the cascade at midday. $1.85 breaks. That triggers stop losses. Traders who bought the dip at $1.85 yesterday have their stops at $1.83. Those get hit. More selling. $1.82, $1.80, $1.78. Step 4 is the panic in the afternoon. $1.75 breaks. Now it's full panic. Margin calls are coming in. Brokers are forced liquidating positions. Traders are selling at market price just to get out. $1.74, $1.73.58. The bottom. Step 5 is the bounce in late afternoon. At $1.73.58, the buyers finally step in. This is too cheap. The fundamentals haven't changed. I'm buying. The price bounces to $76.78 by the close. That's the anatomy of a liquidation event. That's what happens when a market is too leveraged, too speculative, and too fragile. One break of a key level triggers a cascade that doesn't stop until the last leveraged trader is wiped out. And the people who make money? The institutions who sold at $1.90 and bought back at $1.75. The market makers who provide liquidity and collect the spread. The algorithms that front run the stop losses. Not you, not retail, not the guy watching this video thinking he can trade this volatility. Now let's talk about the most important piece of information in today's news. Kitco's headline, gold and silver bounce, but more downside ahead. More downside ahead. Despite the bounce, despite central banks buying, despite the fundamentals, more downside ahead. Why are analysts saying this? What do they see that retail doesn't see? Reason number one is technical breakdown. Both gold and silver have broken major support levels. Reason number two is sentiment shift. The sentiment has shifted from bullish to uncertain to now bearish. And when Kitco, one of the most bullish precious metal sources, is saying more downside ahead, that's a signal. Retail reads that and gets scared. They sell, the price drops, the bearish narrative is reinforced. Reason number three is the leverage unwind is not complete. The analysts know, and I know, that the leverage unwind isn't finished. There are still traders out there holding positions with borrowed money. There are still margin calls that haven't come in yet. There are still stops that haven't been hit yet. Until the leverage is completely flushed out, until every speculator who doesn't belong in this market is liquidated, the selling pressure will continue. Reason number four is macro headwinds. We haven't even talked about the macro picture. What's happening with the dollar, what's happening with interest rates, what's happening with risk appetite in equities. If the dollar strengthens, precious metals get crushed. If real interest rates rise, precious metals get crushed. If equities rally and risk-on sentiment dominates, precious metals get crushed. The analysts are looking at all of this and saying, the setup is bearish, more downside ahead. Now let me play devil's advocate. Let me make the bull case, because there is a bull case, and it's actually pretty strong. Bull point number one, central banks are accumulating. 328 tons in 2025. That's real, physical demand. That's sovereign nations diversifying out of dollars. That's a long-term structural shift that doesn't reverse easily. Bull point number two, industrial demand for silver. The 678 million ounce deficit we talked about weeks ago is still real. Solar demand is still growing. EV demand is still growing. AI data centers are still being built. All of that requires silver, physical silver, not paper promises. Bull point number three, supply constraints. Mining supply is flat or declining. Ore grades are falling. New discoveries are rare. Refining capacity is constrained. The supply side of the equation hasn't changed just because the price crashed. Bull point number four, geopolitical tensions. China is still restricting exports. The trade war is still happening. The dollar's reserve status is still being questioned. The long-term trends that drove gold from $1,800 to $5,000 are still in place. So if the fundamentals are bullish, if the long-term trends are intact, why is the price crashing? Because in the short term, the market doesn't care about fundamentals. It cares about liquidity. It cares about margin calls. It cares about forced selling. It cares about technical levels breaking and algorithms executing pre-programmed sell orders. The fundamentals tell you where the price should be in 2027, 2028, 2030. But they don't tell you where the price will be tomorrow or next week. And that's the trap. Retail investors think the fundamentals are good, therefore I should buy. But they don't realize that fundamentals can be right for years while the price goes nowhere or even down. You can be right about the thesis and still lose money if your timing is wrong or if you're using leverage. Let's look at something most people aren't paying attention to. The gold to silver ratio. At current prices, gold is at $4,174.40 and silver is at $76.78. That gives us a ratio of about 63.5 to 1. That means it takes 63.5 ounces of silver to buy 1 ounce of gold. Historically, the gold to silver ratio has ranged from 15 to 1 in ancient times to 100 to 1 during extreme market stress. The modern average is somewhere around 60-70. So that's 63.5. We're actually pretty close to the historical average. But here's what's important. The ratio has been compressing. A few weeks ago, when silver was at $120 and gold was at $5,000, the ratio was around 41 to 1. Silver was significantly outperforming gold. Now it's 63.5 to 1. That's a massive expansion. That means silver has underperformed gold dramatically in this crash. What does that tell us? It tells us that silver is being treated as a risk-on asset, not a safe haven asset. When markets get scared, they sell silver and buy gold. When markets are confident, they buy silver for the leverage and the speculation. Right now, markets are scared, so silver is getting crushed while gold is only moderately down. If the ratio continues to expand, if it goes to 70, 80, 90, that means silver could drop to $1.65, $1.60, or even $1.55, while gold stays relatively stable. Conversely, if the ratio starts to compress again, if we go back down to 50 or 40, that would signal that silver is outperforming and the bull market is resuming. So watch the ratio. It's one of the most important metrics for understanding the relative strength of these two metals. Let me talk about what's happening in the minds of retail investors right now, because this is critical to understanding where we go from here. Phase one is denial from last week. This is just a healthy correction. We needed to shake out the weak hands. The fundamentals are strong. We're going back to $1.150 soon. Phase 2 is hope from yesterday. Okay, we bounced from $73 to $84. Maybe that was the bottom. Maybe the worst is over. I'll hold on. Phase 3 is fear from this morning. Wait, we're crashing again. We're at $80, $78, $75. What's happening? Should I sell? Should I hold? Phase 4 is panic from this afternoon. We're at $73.58. I'm down 40% from my entry. I can't take this anymore. I'm selling everything. Phase 5 is capitulation, which might come tomorrow or next week. I give up. I'm selling at any price. I don't care anymore. I just want out. Precious metals are a scam. I'm never buying again. That's the psychology. That's the emotional cycle. And here's the brutal truth. Most retail investors will capitulate at the bottom. They'll hold all the way down, refuse to sell at $100, refuse to sell at $90, refuse to sell at $80. But when it hits $70 or $65, when the pain is unbearable, when they can't sleep at night, that's when they'll sell. And who will they sell to? The institutions, the smart money, the patient capital that's been waiting for exactly this moment. That's how wealth transfers from the impatient to the patient, from the emotional to the disciplined, from retail to institutions. Let me lay out 3 possible scenarios for what happens next. I don't know which one will play out. Nobody does. But these are the 3 most likely paths. Scenario number 1 is the slow bleed, and I'd give this 40% probability. Silver drifts lower over the next few weeks. Not a crash, just a slow grind down. $1.76 today, $1.74 next week, $1.70 the week after. Maybe $1.65 to $1.68 by the end of February. Gold follows a similar pattern. $4,874 today, $4,150 next week. $4,600 to $4,700 by end of month. This is the death by 1,000 cuts scenario. No single day is catastrophic, but the cumulative effect over time destroys morale and forces more capitulation. In this scenario, the bottom comes when nobody cares anymore, when the headlines stop, when YouTube views on silver videos drop by 80%, when retail has completely given up. That's typically when the smart money starts accumulating aggressively. Scenario number 2 is the capitulation spike, and I'd give this 35% probability. We get one more massive leg down. Scenario number 3 is the bounce and chop, and I'd give this 25% probability. We've already seen the low. $73.58 in silver was the bottom. From here, we bounce back to $85 to $90 over the next week. Gold reclaims $5,000. Everyone breathes a sigh of relief. But then we start chopping. We can't break above $95 to $100 in silver. We can't sustain $5 to $100 to $5,200 in gold. We just chop sideways in a volatile range for weeks or months. $75 to $95 in silver, $4,700 to $5,100 in gold. This is the worst scenario for traders because nobody makes money. Longs get chopped out on the dips, shorts get chopped out on the rallies. Only the market makers and algorithms profit. Let me tell you what I think the smart money is doing, because this is where retail always gets it wrong. First, the institutions are not panicking. While retail is selling in panic, the institutions are calm. They're not watching the 1-minute chart. They're not checking the price every hour. They're executing a plan that they developed months ago. Second, the institutions are accumulating slowly. They're buying, not all at once, not aggressively, but methodically. $75, $72, $70, $68. They're building positions because they know that in 12 to 24 months, these prices will look cheap. They don't care if it goes lower. If silver drops to $65, they'll buy more. If it drops to $60, they'll buy even more. They're not trying to catch the exact bottom. They're trying to accumulate as much as possible in the $65 to $85 range. Third, the institutions are hedging. They're not just long physical. They're using options. They're using futures. They're hedging their positions so that if the market crashes another 20%, they don't get wiped out. This is the difference between institutional investing and retail gambling. Institutions manage risk, retail chases returns. Fourth, the institutions are patient. They have a 3 to 5 year time horizon. They don't need silver to go to $150 next month. They're fine if it takes until 2028 or 2030, because they know that the fundamentals, the deficit, the industrial demand, the supply constraints, all of that is still real and will eventually reassert itself. Retail doesn't have that patience. Retail needs gains now. They need to make back their losses now. They need validation that they were right now. And that impatience is what kills them. Here's a harsh truth. If you want to know what the right move is, look at what retail is doing and do the opposite. Right now, retail is panic selling, deleting their brokerage apps, swearing off precious metals forever, saying, I knew it was a bubble, calling everyone who recommended silver a scammer. And what's the contrarian play? Accumulating, dollar cost averaging, building positions slowly while everyone else is running for the exits. I'm not saying you should go all in right now. I'm not saying the bottom is in. But I am saying that when sentiment is this bearish, when everyone is calling for lower prices, when retail has completely given up, that's typically closer to a bottom than a top. Bottoms are formed in despair, tops are formed in euphoria. Right now we're in despair, or at least we're getting close. Let's talk about leverage, because this is the lesson that most people will never learn. If you bought silver at $100 with no leverage, you're down 23% right now. That's painful. But you're still in the game. You can hold. You can wait for the recovery. If you bought silver at $100 with 2x leverage, you're down 46%. You're probably stopped out or close to it. If you bought at $100 with 5x leverage, you're completely wiped out. Your account is gone. You lost everything. And here's the thing. The guy with no leverage and the guy with 5x leverage both had the same thesis. They both believed silver was going to $150. They were both right about the fundamentals. But the guy with leverage got wiped out while the guy without leverage is still alive to see the eventual recovery. Leverage doesn't make you more right. It just makes you more vulnerable. And in volatile markets like this, leverage is a death sentence. I've said this before and I'll say it again. If you're using leverage in precious metals, you're not investing. You're gambling. And the house edge is massive. Let me address something that is not being talked about enough. The disconnect between the paper market and the physical market. The paper market, futures, ETFs, options, and that's where the price discovery happens. That's where the volatility comes from. That's where the leverage lives. But the physical market? Dealers are still selling coins at $5 to 10 premiums over spot. Premiums haven't collapsed. In fact, in some cases they've widened. Why? Because when the paper price crashes, physical buyers step in. They say, silver at $1.76? I'll take 100 ounces. That's a gift. So you have this weird situation where the paper price is crashing, but the physical market is actually tightening. Dealers are running low on inventory. Mints are backed up. Delivery times are stretching out. What does that tell you? It tells you that the paper market is disconnected from reality. The paper price can go wherever it wants in the short term because it's driven by leverage and speculation. But the physical market knows the truth. Physical buyers know that silver at $1.76 is cheap relative to the long-term fundamentals. Eventually, the paper market and the physical market will converge. They always do. But in the short term, you can have these massive disconnects where the paper price is collapsing while the physical market is sold out. All right, enough analysis. Let's talk about what you actually need to do right now based on where you are. If you're holding physical silver or gold, you do nothing. You hold. You ignore this volatility. You understand that you didn't buy physical for the next 3 weeks. You bought it for the next 3 years. The fundamentals haven't changed. The 678 million ounce deficit is still real. Industrial demand is still growing. Central banks are still accumulating. The paper price crashing doesn't change any of that. So you hold. You don't check the price every day. You don't panic sell at the bottom. You wait. If you sold during the crash, don't chase it back. Don't FOMO in just because you're scared of missing the bounce. Be patient. Wait for actual stability. Wait for a clear bottom. Wait for the volatility to decrease. If we've truly bottomed, there will be plenty of time to get back in. If we haven't bottomed, you'll get another chance to buy at even lower prices. If you're thinking about buying for the first time, dollar cost average. Don't try to time the exact bottom. Buy a little at $1.76. If it drops to $1.70, buy a little more. If it drops to $1.65, buy even more. Spread your purchases over 4 to 6 weeks. That way, you're not fully exposed at one price level. You're averaging in as the market finds its bottom. If you're trading this with leverage, stop. Seriously, just stop. You're going to lose. The volatility is too extreme. The whipsaws are too violent. The intraday swings are too large. You're fighting algorithms with unlimited capital and zero emotions. If you absolutely must trade, use tiny position sizes. Risk no more than 1% of your account on any trade. Use tight stops. And accept that you're probably going to lose because the house edge is massive. For everyone, preserve capital. This is the number one rule. Don't make desperate moves. Don't try to make back your losses by doubling down. Don't revenge trade. Don't let your emotions drive your decisions. If you lost money, accept it. Learn from it. Move on. Focus on not losing more rather than trying to make it back immediately. Let me give you some historical perspective because this isn't the first time precious metals have crashed. In 1980, silver went from $1.50 to $1.10 in a matter of months. The Hunt brothers tried to corner the market, it failed, and the price collapsed. In 2011, silver went from $1.49 to $1.26 in a matter of weeks. That's a 47% crash. In 2020, during the COVID panic, gold and silver both crashed 15-25% in a matter of days before recovering. Every bull market in precious metals has violent corrections. 30%, 40%, even 50% pullbacks are normal. They're painful. They shake out the weak hands. They destroy the over-leveraged, but they don't kill the bull market. What we're experiencing right now is part of the process. It's part of the cycle. It's the shakeout before the next leg higher. Or maybe it's not. Maybe this is the top and we're heading into a multi-year bear market. I don't know. Nobody knows. But what I do know is that the people who held physical gold and silver through the 2011-2015 bear market, the people who didn't panic sell, the people who stayed disciplined, they eventually saw new all-time highs in 2020, 2025. Patience wins, discipline wins, emotion loses. Let's come back to the headline, more downside ahead. I want you to take that seriously. I want you to understand that we might not be at the bottom yet. $73.58 might not be the low. We could see $70. We could see $65. We could even see $60 if there's a full capitulation. Don't assume the worst is over just because we bounced. Don't assume that buying at $76 is safe. The market might not be done liquidating the weak hands yet. So if you're going to buy, be prepared for it to go lower. Be prepared for more pain. Be prepared for the possibility that you're going to be underwater for weeks or months before you see green. That's the reality of buying into a falling market. You might be early, and in markets, being early looks exactly the same as being wrong. But here's the flip side. If you wait for confirmation, if you wait for the market to clearly bottom and start trending up, you're going to miss the best prices. You're going to buy at $90 or $100 when you could have bought at $75. So it's a trade-off. Early entry means better prices, but more pain. Late entry means less pain, but worse prices. You have to decide which you can handle psychologically. Let's talk about who's actually buying this dip, because it's important to understand who the buyers are. Central banks bought 19 tons of gold in December alone. They averaged 27 tons per month in 2025. They're not stopping. They're accumulating for strategic reserves, for currency diversification, for insurance against dollar devaluation. They don't care about the price. They're buying at $5,000. They're buying at $4,800. Sovereign wealth funds are major players. Countries with massive reserves, Saudi Arabia, Norway, Singapore, UAE, they're allocating 5 to 10% of their portfolios to gold and silver. That's billions of dollars in buying pressure over time. Large institutions like hedge funds, pension funds, and endowments are slowly increasing their precious metals exposure. Not all of them, but enough of them that it creates sustained demand. And high net worth individuals, the billionaire class, are buying physical bars and storing them in vaults. They're not trading, they're accumulating. They view precious metals as insurance, as a hedge, as a store of wealth that can't be debased. These are the buyers. These are the entities with patient capital, long-time horizons, and deep pockets. They're not selling in panic, they're accumulating in chaos. Let's zoom out and look at the macro forces at play, because the precious metals market does not exist in a vacuum. The dollar is a key factor. If the dollar is strengthening, precious metals get crushed. Dollar strength makes gold and silver more expensive for foreign buyers, reducing demand. Interest rates matter immensely. If real interest rates are rising, precious metals get crushed. Higher rates make non-yielding assets like gold and silver less attractive. Risk appetite is critical. If equities are rallying, if risk-on sentiment dominates, precious metals get ignored. Money flows into stocks, crypto, high-risk assets. Gold and silver get sold. Inflation expectations drive behavior. If inflation expectations are falling, precious metals lose their appeal. One of the main reasons to hold gold is inflation protection. If inflation is moderating, that narrative weakens. Right now, all of these factors are probably working against precious metals. The dollar is likely strong. Real rates are probably positive. Risk appetite is probably decent given the equity market. Inflation expectations are probably moderating. That's the macro headwind. That's why analysts are saying more downside ahead. The macro setup is bearish. But here's the thing about macro. It changes. The dollar can weaken, rates can fall, risk appetite can turn negative, inflation can spike again. And when those macro conditions shift, precious metals will respond. The question is, when does that shift happen? Next month? 6 months? A year? Nobody knows. Let me talk about a psychological trap that's destroying traders right now. Anchoring bias. If you bought silver at $120, your brain is anchored to that price. You see $76 and you think, this is cheap. But cheap relative to what? Relative to $120? Sure. But what if $120 was the top? What if fair value is actually $60 or $50? Your brain doesn't want to accept that. Your brain wants to believe that $120 was just the beginning and we're going to $200. So you hold, you refuse to sell, you might even buy more. But if $120 was the top, if we're heading back to $60, then holding at $76 isn't brave. It's foolish. This is anchoring bias. You're anchored to a past price that might be completely irrelevant. The same thing happens with gold. If you bought at $5,000, you're anchored to that level. $4,974 feels cheap. But what if $5,000 was the top for this cycle? The way to combat anchoring bias is to ignore your entry price. Forget what you paid. Look at the current price and ask yourself, if I had cash right now and no position, would I buy at this level? If the answer is yes, hold. If the answer is no, sell. Your entry price is sunk cost. It's irrelevant to the decision you need to make today. All right, let's wrap this up. After 10,000 words of analysis, what's the verdict? For physical holders, hold. The fundamentals are still intact. Central banks are still buying. Industrial demand is still growing. Supply is still constrained. The paper market is chaotic, but the physical market is real. Your timeline is years, not days, so hold. For traders, if you're profitable, take profits and sit on the sidelines. If you're underwater, cut your losses and preserve capital. Don't try to trade this volatility unless you're a professional with risk management systems in place. For new buyers, dollar cost average into physical, small amounts, over weeks or months. Don't try to catch the exact bottom. Spread your risk. And be prepared for more downside before we see upside. For everyone, manage your emotions. Don't panic. Don't revenge trade. Don't make desperate moves. Capital preservation is more important than capital gains right now. The market is telling you something. It's telling you that the easy money has been made. It's telling you that the bull market, if it continues, is going to be volatile, painful, and full of traps. If you can't handle 25% intraday swings, if you can't handle 40% drawdowns, if you can't handle months of sideways chopping action, then you shouldn't be in this market. But if you have the discipline, the patience, and the capital to weather this storm, the long-term thesis is still intact. The deficit is real. The demand is real. The supply constraints are real. Central banks are real buyers. Eventually, the paper market and the physical market will converge. Eventually, the fundamentals will reassert themselves. Eventually, this chaos will resolve. The question is, can you survive until eventually arrives? This is the American Guy. It's Wednesday, February 5th, 2026. Silver crashed 12.83% today, down $11.30 to $76.78. The intraday range was $73.58 to $92.32. That's a 25% swing from low to high in one day. Gold dropped to $89.40, negative 1.80%. Central banks bought 328 tons of gold in 2025. They're still accumulating. But it doesn't matter in the short term because the paper market overwhelms the physical market. Analysts are warning more downside ahead. This isn't over. We might see $70 in silver. We might see $4,600 in gold. The leverage isn't fully unwound. The weak hands haven't fully capitulated. But here's what I want you to remember. Markets don't move in straight lines. Bull markets have corrections, sometimes brutal, violent, soul-crushing corrections, but they don't invalidate the long-term thesis. If you're holding physical, hold. If you're trading, preserve capital. If you're buying dollar cost average. And if you're panicking, step away from the screen and take a deep breath. This too shall pass. The volatility will decrease. The market will find a bottom. And when it does, the people who stayed disciplined, who didn't panic, who didn't sell at the worst possible time, they'll be positioned for the next leg higher. Or maybe they won't. Maybe this is the top and we're heading into a multi-year bear market. I don't know. Nobody knows. But what I do know is this. They can't print silver. They can't print gold. They can print dollars. And eventually, that's going to matter again. Stay disciplined. Stay patient. And don't let this volatility destroy you. This is the American Guy. Hold the line.